Have you ever wondered why everyone keeps talking about the S&P 500? Experts, wealth managers, billionaires, seasoned investors, all going on about S&P 500. Have you wondered, what is it about the S&P 500? What makes it so amazing? Why is everyone talking about it? Well, in this video, that's exactly what we're going to talk about. We're going to examine what the S&P 500 is, and more importantly, what's so amazing about it. Before we go any further, please bear in mind that nothing I say in this video is financial advice. This is purely for educational purposes, and if you need any help, do your own due diligence and consult a professional. So if you can take a few seconds now, just click on that like button for us, click on subscribe if you haven't already, click on the notification bell, and just leave a little comment on the comment section below. Maybe tell us where you are in the world. So what exactly is the S&P 500? The S&P 500 is actually not a stock. It's not something you can actually buy into. You can't buy it directly. What it is, it's an index of the top 500 or so companies in the United States. So when I say index, think of it like a league. So if you're familiar with the league system in football, in England, we've got something called the Premier League. And within that league, you have a list of the top 20 teams in England. In Spain, you've got La Liga. In Italy, you've got Serie A, and so on and so forth. Think of it this way. In the United States, the S&P 500 is the league that has the 500 largest companies in the United States. So similarly, in football, you've got companies that don't perform and don't meet the criteria that are sometimes kicked out and then replaced by new ones that meet the criteria. So just like in Premier League, where some teams are relegated from the Premier League into the Championship, and those from the Championship come up and replace those in the Premier League, in a similar fashion, the S&P 500 also kick out some companies and replace them with other companies. So because the United States economy is so big, the companies in the S&P 500 are not only the largest in the United States, many of them are also some of the largest in the entire world. If you think about companies like Apple, Microsoft, Nvidia, these are absolutely huge companies. And when you look at a world fund that covers all the major companies around the world, the United States on its own, the S&P 500, covers around about 65%. So that's how massive these companies are. And we're talking about household products that you and I use, the iPhone. You're looking at things like the Google and Facebook. These are all companies within the S&P 500. So not only are they massive in their home country, they cover a massive amount of capital in the entire globe as well. So typically when you hear someone say the market, if you say the market has fallen today or the market is in the green today, what they're typically talking about is the S&P 500. So that is the benchmark that most people measure any other investment against, because it has a very good way of reflecting the overall condition of the US market, and in turn, because the US market is such a big reflection on the world market, the overall health of the world market also. Remember I said that you can't just buy into the S&P 500 directly. Well, technically you can, I suppose. You can just buy these stocks of the companies individually, but that's going to be a bit of a pain, and when one's kicked out and one's replaced, then you're going to have to do all the rebalancing yourself. Instead, most people just buy an S&P 500 fund. And the way that works is that a fund manager, so that could be a very large investing company such as Vanguard, will buy the stocks of each of those 500 companies and put them all together into one fund, usually in the form of an ETF or in some cases other formats. But within the fund they create, they'll then allocate the money based on the size of each company. So for example, Nvidia is the largest company in the S&P 500. So if you were to invest, say, £100 in the S&P 500, Nvidia will get the largest share of it. And then the likes of Microsoft will get some. And then the likes of Apple will get some. And the smaller ones will get less and less and less. So it's usually done on the average weighting system. There are some funds out there that do it based on equal weighting. So each company, if you put £100 in, each company will get the equal amount of money invested. But typically it's done based on the average weighting, like I explained. So for example, if we look at the S&P 500 fund here by Vanguard, so this one is ticker symbol VUAG. If you scroll down, you'll see a list of the fund allocation here. If you click on see all, you'll be able to see how the funds are allocated. So you can see Nvidia being the largest gets 7.59%, and Apple, which is the next one, gets 6.89%. Microsoft gets 6.16%, and so on and so forth. So if you wanted to see the full list, if you click on see all, if you go right at the bottom, you see that the smaller companies get smaller and smaller of the pie. So you've got the likes of Moody's there, that only gets 0.13%, and that's not even the smallest one. You've got other companies such as Ford that gets 0.09%, and if we kept scrolling and scrolling and scrolling, we'll find that even smaller companies, so this is smaller in terms of actual market size, get even smaller and smaller piece of the market. So SanDisk will get 0.06%, for example. You got Paychex that gets 0.06 as well. So you get the point. So the simple point is, the larger companies get a larger part of your share when you invest in the S&P 500 funds. That's designed with the weighted average. I'll show you another example. So if you go into if you search S&P 500, you can get a different one which is equally weighted, like this one for my shares. So if you have a look on this one, it's still the same 500 companies, but in this case the fund manager will be distributing the money equally across the board. So once again, let's have a look. If you look at the fund allocation, you click on see all, you see that they all get roughly about the same. So 0.24, 0.22, and so on. There are still little tiny differences, but that's mostly because you can't share the money equally amongst all of them. But we're talking 0.01 difference in the amount of money they get. So that's another way of doing it, but most people won't bother doing it this way. Most people just buy the average weighted versions, but whichever version you decide to go with is completely up to you. So what makes the S&P 500 so popular? The first reason is very simple: diversification. First of all, you're buying 500 different companies. So that's 500 different companies in different sectors also. So you got things like technology, you got healthcare, you got industrial, you got food, you got tobacco. So you got all different sectors covered off by buying one simple fund that covers the entire S&P 500. So you don't have to worry about covering different aspects because they're already represented in there. Now imagine you invest your money into one company and that company fails. That means that you lose your entire investment. Whereas if you invested in the S&P 500, you've also got this protection of 499 other companies if that one company fails. So it gives you that extra peace of mind and extra protection as well. Also, if you remember earlier, I said some of the companies that don't perform well, that don't meet the criteria, simply get kicked out. And then newer companies that are performing better and meet the new criteria will automatically be promoted and replace those that are being kicked off. That means that the S&P 500 is constantly changing, and it also puts the onus on the businesses to keep performing in order to retain their places in the S&P 500. The second reason the S&P 500 is so popular is based around the historical performance of the index. Over the long run, the S&P 500 has delivered on average 10% returns to investors. Of course, it's not 10% every single year. Some years are good, some years are not so good. There have been crashes, there have been recessions, there have been wars, and even global conflicts. Yet the S&P 500 has shown amazing resilience to bounce back and continue to grow. Of course, this is not guaranteed, but there's a long track record there to go by. The third reason the S&P 500 is so popular is based around the magic of compound interest. Now, if you remember earlier, I said that the S&P 500 historically has delivered around 10% returns to investors. The magic is, the longer you leave the money invested, the more your money grows and the faster your money grows. This means that over a period of say 30 or 40 years, your £200 per month in the S&P 500, given that you achieve the average of 10%, could grow as much as £500,000. If you were to increase say £200 into £500 per month and you stayed consistent with that, that could actually grow to well over £1 million. This is the power of compound interest, and the S&P 500 has been known to deliver this over the years. Of course, none of this is guaranteed, and there are market turbulences but this is the average returns, and this is something that people absolutely love about the S&P 500. The fourth reason the S&P 500 is so popular is to do with the fact that most advanced investors simply cannot beat it over a long period of time. I'm talking people with all the best technology, they've got a whole team of analysts, they've got all the tools, they've got all the information, they've got all the data, and they still can't beat the S&P 500 in most cases. In fact, around 92% of the time, the S&P 500 wins over a long period of time. That means only around 8% of advanced investors consistently beat the S&P 500. The fifth reason the S&P 500 tends to be very attractive to investors is to do with the low fees, especially if you compare it with actively managed funds. The S&P 500 tends to be passively managed, which means that computer algorithm is picking the companies that go into the fund. It doesn't discriminate, it just goes purely based on the criteria set. In comparison, actively managed funds have fund managers. These are people who've gone to school, they've gone to the best universities in the world. Of course they want to get paid. In addition, they've got analysts, they've got computers to pay for. All these things cost them money, so they'll also pass some of those costs to the investors. So even if you had a 1% increase in fee from an S&P 500 versus an actively managed fund, that would make a massive difference and will compound over a long period of time. To make matters worse, as I explained earlier, most actively managed funds can't even be the S&P 500. The sixth reason the S&P 500 is so popular is simply because Warren says so. Yes, Warren Buffett, the legendary investor, the one that's widely regarded as the best ever, actively promotes the S&P 500 as the best solution to most investors' requirements. In fact, there was a time he placed a bet with anybody who would take it that the S&P 500 would be any actively managed fund over a long period of time. And guess what? He actually won. He placed $1 million and he won that bet. And that proved how good the S&P 500 was, and that raised the popularity with investors. But hold on a minute, nothing's perfect. The S&P 500 is definitely not perfect. There are some risks that you need to bear in mind. The number one risk is that the S&P 500 is not guaranteed to give you any returns. In fact, there are times where it's giving negative returns. Even though I said earlier that the average return is 10% per year, it doesn't mean you're going to get 10% every single year. Sometimes you get more, sometimes you get less. The problem is a lot of people go in expecting a minimum of 10% and then feel disappointed when they don't get that. And the biggest mistake they make is that when the index falls, some people panic and sell, therefore locking in the losses rather than giving it time to rebound and recover from those losses. The second risk to consider is a geographical one. The S&P 500 only covers the 500 largest companies in the United States. That means even though it's diversified in terms of the sectors, it's not diversified in terms of geography. So if the United States economy went down, for example, or there was a major disaster or something really bad happened, it could actually drag your entire portfolio down if the S&P 500 fell. So a lot of people balance this by including other funds that cover different areas of the world. So you might get something that covers the entire world, for example, or parts of Europe or Asia or emerging markets to balance out the portfolio rather than putting all your eggs into the United States market only. The third risk to consider is something called a concentration risk. The top 10 holdings in an S&P 500 index fund account for approximately 40% of the fund. That means that if these top 10 companies perform badly, they can drag down the entire index, even though the remaining might be doing well. So it's something that a lot of people have a problem with because they don't like the fact that there's so much power and there's so much weighting behind such a small number of companies within the entire index. So with all that being said, let's answer the original question. What's so amazing about the S&P 500? First of all, you get diversification. There's 500 companies in all different sectors automatically covered once you invest in the S&P 500. Also, you're investing in the largest companies in the largest economy in the world, the United States. Thirdly, they tend to be quite low cost, which means that you'll have a lot more money going into your investment rather than paying someone else the fees. Fourthly, you got a situation whereby the computer kicks out the bad performers and replaces it with the good performers. So automatically the portfolio rebalances itself. Number 5, Warren says so. The greatest investor in the whole world says that the S&P 500 is the best option for most people. Obviously, it's not financial advice, that's his advice, but he was so sure of himself that he put on a bet and he won. Next, he's got a long historical record of delivering around about 10% to investors over the long term. And this 10% has compounded and has made a lot of people accumulate wealth over time. So there we have it. Now we know why the S&P 500 is so amazing. I really want to know your thoughts on this one. Leave a comment below. If you agree with me, leave a comment saying I agree. If you disagree, let me know why also. Perhaps you use a different index rather than the S&P 500. You might use a world one, or you might prefer the FTSE 100. Leave a comment below, let me know which one you use. Better yet, if you use individual stocks, leave a list of the stocks that you believe in that will be the S&P 500. That'll be a very interesting debate to have. More than anything else, thank you very much for your time. Don't forget to like, subscribe, share this, and thanks once again. Join me next time. It's Roadman Investor.